Thank you for joining us today during our lunchtime talk. I can also remember that last year, 1 year ago, exactly on this date, we also had our Consumer Connect, of course, during the circuit breaker itself. But at that point in time, we actually had it in the late afternoon because everyone was working from home. But today, we shift this forward to a lunchtime talk because 75% of us can actually go back to office and work now. Although I know that Stanchart, I think, allows, I heard, up to 80% of the people to actually work outside of the office. And just yesterday on the LinkedIn survey, they are also ranked number 3 as the top employer of choice among people looking for the company to join. I think Stanchart is doing something that is fantastic there, that's attracting people wanting to join them as the employer of choice. So today, we are very honored to actually invite Audrey from Standard Chartered Bank to share with us on the global investment outlook. Let me share a bit on Audrey itself. Audrey is a senior cross-asset strategist at Standard Chartered Bank Wealth Management Group. She actually works in a team responsible for identifying investment opportunities and across asset classes globally. She's a key member of the Global Investment Committee, and she's responsible for the formulation and delivery of the bank's view and relevant investment ideas to the retail bank and private bank. She has significant experience in financial markets. She has previously worked in high-bridge investments, previously known as AIG Global Investments, where she was responsible for stock selection and asset allocation for Asia ex-Japan equities. Prior to this, she worked in Taiwan as an equity analyst in the technology space. Audrey is now based in Singapore and has previously lived in Taiwan and Europe. She is a chartered financial analyst and holds a BBA in finance from the National University of Singapore. She regularly contributes her views to the region's newspapers and magazines. For the rest of my colleagues here, I don't think I need to introduce myself. You all will know me, Director of Research for Huttons. So again, I also contribute my views to the newspapers as well as on TV. So I will share on what has happened in the property market in the first quarter of 2021, and also, of course, since the circuit breaker, and also touch a bit on the District 15 and then move on to the outlook for the rest of the year. So without further ado, I hand the stage over to Audrey. Audrey, over to you. Audrey, we can't hear you.
Hi, it's Teck. Can you hear me?
Yep, loud and clear.
Okay, perfect. Now, can you let me know if you can see my screen in front of you?
Still waiting.
Is it showing up? Okay.
Not yet.
Okay. Let me know once you see something pop up, okay? No? Still nothing?
No.
Okay, let me try again. 1 second, please. Sorry for the delay here. 1 second, okay. Let me refresh it again, okay. All right, in 3, 2, 1. All right, 1 moment. Now, do you see my screen now?
Yep, can.
Okay, great, perfect. All right, once again, good afternoon, everybody. And Teck, thanks so much for your kind introduction. And thank you all distinguished guests for joining us this afternoon. Before I agreed to this webinar, I was actually thinking if I should be focusing more on a Singapore market outlook or more of a global investment outlook. And in the end, I chose to go for the later, the more global part, okay? Why? Because many of the investors I speak to tend to have a home bias. So for example, if I'm meeting Singapore-based investors, they tend to own a lot of Singapore equities, the REITs, local banks. And similarly, if I'm speaking to someone in Hong Kong or China, they will tend to have a lot of their holdings in Hong Kong, China, bonds and equities. Now, you may ask me, why does that matter, right? Well, simply because when I look at the performance of Singapore equities, say versus US markets over the last 2 years, Singapore markets has underperformed by almost 50%. Okay, and if I bring the horizon further to the last 3 years, Singapore underperformed US by 65%, and the last 5 years it's 123%. Now, there's a lot of percentage points of performance to be giving up, especially when our interest rate today in the bank is close to zero. So for anyone who is investing in financial markets today, you'll be missing out on a lot of opportunities elsewhere outside of Singapore if you're just purely focused on the domestic financial markets alone. Hence this session today about global investment outlook, right? Now, we're 1 year into the pandemic. Global markets have rebounded higher. In fact, in many of the places, they have gone back up above pre-pandemic high, more so in the US and elsewhere. But even in Singapore, the local stocks are also back to 2018 high. And many investors are asking me today, what should we be watching out for as we progress through the year? And here are 4 key factors that's out on the screen, which we really think are important for investors to be keeping an eye out for. COVID vaccine, certainly important, whether we look at the from a distribution perspective or from an efficacy or the efficiency of the vaccine perspective. Distribution, as all of you will be aware, US and UK is leading the pace, so they should be able to achieve herd immunity, get more of their citizens immunized by late summer, sometime in August or September. In the case of Europe, some hiccups there in terms of distribution, and the EM markets, emerging market space, certainly more to be done in the vaccination space in order for economic activities to normalize. But the good news is, if you look at the efficacy front, the vaccine seems to be broadly effective, regardless of the strain of the virus. Say, for example, some of the data I tracked when we were in the first wave of the pandemic, we saw that the elderly was the most impacted. And now they are the least affected because they are all getting vaccination as a priority. While certainly we are a long way from zero COVID cases, we believe that we are certainly making progress on vaccinating more and more people, and certainly towards greater economic normalization and reopening. Now, the second factor is on policy. We've just had the Federal Reserve Central Bank meeting last night, and I think in short, policy, at least on the monetary policy front, is likely to stay highly accommodative over the course of this year and into 2022. In fact, I found it quite interesting when, post Powell's prepared remarks, the first question that was asked of him is, when do you expect to be tapering? And he said, not anytime soon, not yet, okay, and basically gave a list of reasons why he believed that it is still some time before economic activities can normalize. And what this means is interest rate yields will potentially stay quite benign for an extended period of time over the next 1 or 2 years. And we've also seen the market pushing or postponing the rate hike expectation from sometime beginning of next year to end 2022 and beyond, before the Fed would even consider having the first rate hike. And certainly in terms of the macro environment, what this means is that we do expect potential yields to rise modestly over the course of the year, but most likely real yields will stay quite range bound, and that will have an implication on US dollar, which we shall talk about it more maybe in the Q&A section. Now, what does that mean for the macro environment then? Because if you look at in terms of key economic data, we can certainly see a US market leading the way. In fact, it has one of the highest growth momentum at the moment, and certainly UK is not far behind as well, recovering sharply as the economies are gradually reopened. Europe as well as Japan, someplace away, but we do expect them to rebound as we progress later through in the later half of the year. And to some degree, that's also reflected in inflation data. For example, we've seen US having the highest inflation data this year so far, and Euro area is also picking up quite significantly. Investors will certainly be looking at this quite intently to see how central bank responds to higher inflation. Our sense is central bank will probably look through that, given that we probably see inflation rising higher this year, but potentially moderating lower towards 2022 as we resolve some of the supply chain bottleneck that we are seeing at the moment. Obviously, many investors, including myself, we are all worried about the impact of higher bond yields and what that may mean for our mortgage rate, for example, what that may mean for financial assets, particularly equity markets or even bonds. And here I thought this table is quite an insightful table because if I were to illustrate to you what this table is telling us, basically on the left-hand side, you can see the different periods of rising bond yields. And on the bottom, basically shows you the different equity regions and sectors. And what green means is that during those periods of rising bond yields, you have positive returns. And red means that during the specific period, the returns were negative. And as you can see from the slide in front of you, it is not totally green, but certainly during periods of rising bond yields, we've seen more greens than red among equity asset classes. Especially if you were to exclude the three periods, which is in the light gray segment, where we've seen higher bond yields, for example, in 2000 and 2008, as well as most recently, we've seen higher bond yields, basically leading the global economy into a recession. And not surprisingly, during this period, actually equity market performed quite poorly. But if you were to strip out this period, the entire picture actually looks a lot greener. In fact, even during the taper tantrum, which is the black color cell highlighted, we're basically seeing positive returns across most broadly, other than within the EMX Asia space, where we saw some negative returns on the back of taper tantrum. So overall, we think rising bond yields is a sign of confidence in the economy. We don't think we are anywhere near a recession, and that that to us reflect potentially rising risk appetite that will lead to the continued performance of equity market, which is our preferred asset class going into 2021 and beyond. Now, one of the recurring questions that I've been getting from clients is, then what is the risk of a pullback? Because a lot of equity markets are now at record high. And certainly, if I were to think about it today, that is indeed a very valid concern. We've got pretty stretched technicals, and at the same time, equity markets are not the cheapest out there. Biden is also talking about proposing tax hikes and capital gains tax in order to fund his various stimulus plans that he's announced recently. So arguably, the probability for a market pullback today is higher than, say, back in January when the markets were 10% lower, okay? But at the same time, let's just not forget that there are mitigating factors as well, because if you look at fundamentals in terms of corporate earnings, corporates are delivering very, very robust set of earnings in the last couple of quarters. In fact, right now, we are in the middle of U.S. earnings season, and more than a third of the companies have reported so far, with over 80% of them actually beating consensus earnings estimates. And importantly, if you look at the chart in front of you, analysts are also revising up their estimates higher. So if you look at the black line in front of you, you can see that analysts since the beginning of this year has been revising up their earnings estimates higher, and that's also supporting higher PE multiples. And one thing to take note is that unlike usual years where analysts tend to progressively reduce their earnings estimates from the beginning of the year as we progress through the year, this time round, the growth estimates have in fact been progressively revised up higher as we emerge from economic recovery. And year to date so far, we have yet to see a 5% decline in equity markets. In fact, the last correction in global equities was sometime in October, November, where the markets fell by about 8% because of COVID-related issues. And so, and since then, the market has been pretty much going up on a straight line without a 5% pullback. So we do believe that should there be any pullback, significant pullback from here, it will offer investors a good opportunity to look at averaging into the market, given the very supportive earnings backdrop as well as policy backdrop that just mentioned about earlier. Now, in terms of the key themes that we like for this year, one of the themes that we've been talking about has been value-style equities. Value-style equities refer to some of the more cyclical sectors, such as financials, such as energy, industrial, and the materials equities. And these sectors tend to be more economically sensitive. They will benefit from a broader vaccination. They will also benefit from Biden's infrastructure plan, which will see increased demand for commodities, industrial equipment, and more. And more importantly, if you look at their performance so far, last year in 2020 was the single largest period of underperformance of value-style equities relative to growth style. In fact, value was down by 30% compared to growth style last year in the whole of 2020. So in our opinion, even if value style equities were to simply mean revert to its longer term historical downtrend, that would still imply a very decent double-digit upside when it comes to value style equities, which includes the likes of financials, industrials, energy and material space. In addition to value style equities, we also like ideas relating to climate transition, which is a theme that we believe will endure over the next coming 3 to 5 years or so. And this is on the back of the record number of commitments by both corporations as well as governments that have pledged to reduce their carbon emission target by 2050 and 2060. So the latest addition to this pledge has been the US as well as Canada, where they talk about achieving this net zero carbon emission target by 2050. And in order to do that, this will require a lot of commitments from governments and individuals across the board. In fact, governments will have to overhaul their power grid utilities as well as transportation network, which are the top two sources of carbon emission globally across most regions. And on the back of that, we are quite positive on the renewable energies or clean energy, as well as things relating to the electric vehicle supply chain. If you look at renewable energy today, it is only about 20% of the primary energy supply mix. And in order for countries to achieve their net zero emission target, the share of renewable energy will have to increase very significantly from the current, say, 20% to around 50-60% by 2050. And it is also a similar case for electric vehicle as well, where today, electric vehicle as a share of total car sales in 2020 was only about 2%. And in order for governments to achieve net zero carbon emission, this percentage point will also have to increase tremendously over the next few years ahead. Closer to home in Singapore, for example, the Singapore government recently announced that we will be banning the sales of electric vehicles sometime in 2040. So even in Singapore, that's also affecting us in terms of how we use transport system going forward. So there's tremendous market opportunity that we see here. Now, another key area that we like is on the digital infrastructure space. Here we are talking about the rollout of a 5G network that we are seeing globally today. 5G offers consumers a much higher speed and also better response time. And with that improved functionality, it basically will open up a host of applications as well as use cases that previously weren't as viable. So for example, if you think about the 5G network today, we are able to connect hundreds and thousands of different equipments, allowing smart factory automation to take place. Versus in the past when you can only have one or two equipments connected and really interacting with one another. And as 5G network continues to be rolled out across the world, this, in our opinion, will underpin increased usage for applications that relies on higher speed, increased data usage as well, and certainly increase in the growth of cloud-related computing demand that will spur spending in this area of the market. So in our opinion, regardless of COVID, when is it going to end or even not at all, we believe that the spending on digital infrastructure is likely to set to continue because many parts of our economy today and even within the bank as well, we are all transiting towards a much faster, much scalable digital infrastructure going forward. And with that, now that I've highlighted some of our key conviction themes that we urge investors to be watching out for the next couple of years, I thought I would leave you with this slide, which is basically gives you an overview of what our house view is, as well as some of the key themes I've spoken about earlier. And as you can see, across the board, we're actually quite constructive on equity. We're quite pro-risk. In fact, we are overweight on equity market as a whole. We are underweight on both government bonds as well as on credit, and at the same time on cash as well. And within the equity space, we do have a preference for the likes of US as well as UK. Like I mentioned earlier, both regions are leading on the vaccination front. So what this means is their economies will be able to recover much earlier and much faster. And as a result, that should also lead risk assets as a whole as well. We are slightly underweight on Europe in this case, but then we will monitor this view relatively closely because should there be any change in the pace of the vaccination, that will allow the European economies to start to hopefully do better going forward. So that's also one area that we are watching out for over the next couple of months ahead. And with this, maybe let me pass it on to Teck and see if there's any questions on the line for the Q&A session. Thanks very much.
Okay, thank you, Audrey, for the insightful sharing. If you have any questions that you would like to ask Audrey, you can actually type them in the Q&A at the bottom of your screen, and then she will pick up the questions and she will answer them accordingly.
Teck, if there are no questions, we can also move on to your section, and the guys can feel free to pop in any questions in the Q&A, and we'll be happy to address them later as well.
Okay. I mean, if I'm fine, we can also leave the Q&A until the end. Then in that case, I can start my sharing now. Let me just share my screen. All right, thank you, Audrey. And now I shall take over to talk about the property market. So today I'm going to talk about again the demand and supply in the market itself, and then that's where you can see where the market is going to head towards in the coming quarters, as well as maybe into next year also. So of course, first of all, is the disclaimer. Okay, this chart here so-called simplifies the whole supply and demand that you can apply across everywhere when you want to buy things and so on and so forth. So when you have the supply and the demand, they are in equilibrium. That means your demand and the supply matches. You have 10 people wanting to buy, you can have 10 units of goods to sell to them. That's in equilibrium, and then therefore you can have a price match, and that will be a price. But when your supply is lower, that means the orange line here that you see, that means, let me change my pointer. Okay, when this orange line here, that means your supply gets lesser. This line moves upwards. That's where this point here, the equilibrium, now will no longer be here. It will move up to say here, because your quantity, which is denoted by Q, gets lesser. And you can see that correspondingly, your P, which is your price, actually moves up. That means the price will increase. So if we can so-called understand this concept, you can usually apply it everywhere that you want to explain all these different things to, whether to your customer or to any other people on the ground as well. So over here, in the first quarter of the year, we have prices accelerating 3.3%. Actually now it's an all-time high, much higher than what we had in 2013, which was the peak. And in the entire of one quarter itself, 2021, the whole price increase was much more than what we had in 2019 as well as in 2020. So the prices has moved up very, very fast. But why did the prices move up so fast? And of course, when that happens, there is actually risk also of government stepping in, which I will address a bit later on in my sharing at the back. It has gone up so high in terms of the prices because of the demand in the market. Demand is substantially much stronger than what we had during the circuit breaker and even before the circuit breaker. If we see from this chart over here, where we split into three portions, you have the pre-circuit breaker, circuit breaker, and post-circuit breaker. So the pre-circuit breaker period, October to March, you can see that the average monthly sales generally hovers about 800, 700, 800, this kind. during circuit breaker, because sales gallery were closed and all this, so the sales number actually came down to only less than 600 units per month. Once the circuit breaker was lifted, that's where we can go down to the sales gallery, and then sales actually shoot up to more than 1,000 units per month over here during the July to September period. It took a bit of breather during the last quarter of the year, but then coming back into the first quarter of this year again, it has gone beyond 1,000 units per month. So if we are to look at, say, since the circuit breaker until now, that means July until March 2021, July 2020 to March 2021, on average, you will see more than 1,000 units being sold every month in the property market. So people are actually putting their money into property. Why is that so? There are two things here which I put into these 4 main points. First is the attractive price point. We do not have, say, developers coming in or developers launching their project at much significantly higher prices compared to what we had in the before the circuit breaker or even before the COVID and everything. And some of these are really priced at very close to what you can find in the resale market. For example, like one particular project in District 5 in Cravon and also at Normanton Park. The price when it came out, it is actually comparable. First, say Cravon comparable to a resale project, which is just next to it. It's very close. And then at Normanton Park itself, it come out at on average $1,006 per square foot. It's actually very close to all the new launches within District 5 itself. So this actually gives people a lot of incentive and they actually have the ample liquidity to actually enter into the market. And then when we talk about other projects that, for example, at the Reef at Kingstock, it was one of the first few projects in the Greater Southern Waterfront to be actually offered for sale. And because of the potential growth in the area, so people are buying in with a view to the future, getting the first mover advantage in first. And these transformation plans that government has does not just apply we are just looking at Greater Southern Waterfront. There are also other plans in other parts of the island when we had these new launches coming up. By people are looking at the potential and therefore they are entering the market. Of course, the low interest rate for one is something that actually drives people to actually look for an asset class that actually gives them stable return. And like what Audrey shared earlier, they are so-called not in favor of people holding cash. I think the reason is because the interest rate is very low and you're getting close to zero. If you put your money in the bank, you should look at other asset class that actually gives you better returns that can actually beat the inflation, and then on top of that, there are something back to you at the end of the day. And of course, another reason that's driving demand in the market now is actually ample liquidity. There's a lot of cash in the system, not just because of the government pumping cash into the system because of COVID, but of course for other reasons also, because when the stock market came down in March last year, some people who took the risk to enter the market, they will have cash out and then makes quite a fair bit of money there. And there were people who actually went to buy Bitcoin, and when they exit, they also realized very huge capital gains also. Like Bitcoin from pretty low, and then now it's $50,000 US dollars for that in that matter. Just like yesterday when I had lunch with other people, he was sharing with me that one person actually used the profits from Bitcoin to put down full cash for a 5 million landed property. So you can imagine the so-called equity market has made quite a fair bit for some of these people out there in Singapore as well. That's why there's ample liquidity and they are actually putting some of this into the property market. And when they do that, they actually drives down the number of unsold stock in the market. Right now, we are actually at a very, very low, and in fact, I would term it dangerously low, which I have told the media itself. Right now, the unsold stock is about 21,602. If we are down by a lot from the previous high of 36,000 unit, and at this current level, we are just 6,500 unit away from the record low, which was about 15,000 unit. So we are getting lesser and lesser stock on the market every day. And at this kind of level, it was, if we look at into the past, it was when Sun Fu View went en bloc. That kickstart actually the whole en bloc cycle itself. And then when the en bloc cycle start, you can see from here is that after a while, prices start moving up. And this time round, we are not even seeing that the market is trying to find its footing and recovering. We are still on an uptrend. So when we have en bloc coming up, it will naturally also support the prices that we have at this point in time. Even if land prices are not going to move up significantly, even if it just move up a bit, you will see property prices being supported and it will continue to move northwards. And then can we increase the supply is the other question probably on your mind. We can increase the supply so that we can actually so-called ensure that whatever we have that is unsold can be moved back upwards to a more sustainable level. But however, to do that, you really need to inject quite a fair bit of land into the market so that they can be translated into stock for people to purchase. And this kind of process actually takes time. When even the GLS supply, just take a look at this. During the market uptrend, the gray line here shows the price index when the market is moving up. UI at that point in time, actually every half year when they have the government land sales, they release on average 4,800 or 4,900 units every half year. And when the market came down, it was cut by more than half to 2002. And this time now, you see the green line, we are on an uptrend. However, the number of stock land supply that are pushing out into the market is still even lower than what we had during the market downtrend. We need to have quite a substantial change in terms of our land supply to move us back up to even hit the 2,200 units or even back to an even higher level. And then even when, say, the government pushed land out in the second half of 2021, the government land sales program, it is not going to come into the market immediately. Let's say I push one piece of land out in July and I allow the tender to close 3 months later in October. By the time the developer get approval and everything, it will be sometime in 2022. And if developer decide 2022, they do not want to launch, they will push it to 2023. So you can see that there is this kind of delay effect when you actually push land out. So we are really right now stuck at this kind of unsold stock level for this year and probably for the early part of next year. And then there's this new regulation that came out in 2019 that actually affects the supply. I will touch on that later on. Then can we say the private market supply more land? Yes, they can. But then again, through the en bloc process, it is also going to be slow because if there's any objection from any subsidiary proprietor to the sale, it goes to the strata title board or even worst case go to the courts. That's going to lengthen the whole process. And then plus getting approval and everything, you are not going to see any, say, this kind of land that got sold in 2021 coming out in 2022 or even coming out in 2023. So again, there's this delay. And this is actually in a way not healthy for the whole market because it puts us not on a sustainable basis. The new regulation I highlighted in the chart earlier, which I need to refresh everybody's mind here, is that in late 2018, UIA actually cuts the number of units that's allowed to build in private residential developments itself. So, and this actually takes impact on the 17th of January 2019. So any approval, any application to build residential projects afterward will be subject to this new rule. So, but what is this new rule itself? What URA has done is that on a particular piece of land, they now mandate that the average size of a dwelling unit there must be 85 square meter or 100 square meter. And this applies to projects that is outside the central area. So what does it mean exactly for you, and where is this central area itself? Now, the central area in Singapore is very, very small. It's on this map here that you can see. Much of it is actually in the CBD, and some of it is in actually your District 9 and even District 7. So it's not a very big area. So if you are looking for a investment product, a unit that is actually small and then palatable in terms of quantum, you are likely to find them within this central area after 2019 moving once. That's why when the new projects that comes out, you can have studio units or studio units coming out to about 400 odd square feet. But whereas when you go to outside the central area, you can see that right now the smallest that you can find is probably more than 500 square feet. So that is a difference of say 80 to 100 square feet in terms of the sizes after the new ruling took effect. And then with that, because that actually reduced the supply, but then demand-wise, when this survey was done by one of the listing portal in 2019, actually a lot of people chose District 15 as their preferred choice that they want to stay in. So I will use District 15 as an example to show the impact of this policy change on supply and demand in the area. So District 15 is not new to this average size ruling from URA. As early as 2011, URA actually has this kind of so-called policy on developments in District 15 already, like in the Joo and the Telok Kurau area. Why do they have this 70 square meter rule at that point in time? Because there were quite a number of landed homes in Telok Kurau and Joo area being converted to low density non-landed homes. That actually places a lot of stress on the road network. That's why they need to ensure that the number of units built there do not increase at quite exponentially. That's why they have this. Then comes 2019. These areas that we have marked out here on the map in red are areas where they are subject to the average 100 square meter rule. And you can see from here, Joo Chiat, Mountbatten, your Telok Kurau, and Marine Parade. Quite a fair bit of them falls under this average 100 square meter rule. And how much, and this actually in District 15, how much of this actually in District 15 and what can we expect? We can see from here, we so-called explode this map up. Which are the places that are here where highlighted is predominantly HDB, and then Tanjong Rhu is not affected at all. You are left with this in orange and this area. These two areas are totally not affected. But can developer touch this area to build them into non-landed homes? The short answer is actually no, because these areas like your Branksome Goodman area and even your Siglap area, they are all zone landed. So in a way, the government is going to so-called preserve the character of this area and likely to let them stay as a landed estate itself. So when you look back onto this, actually almost all of District 15, with the exception of the HDB and Tanjong Rhu area, are actually affected by this 100 square meter rule. And this is going to have an impact overall, because when you have a larger unit size, like I said earlier, your supply will be lower. When they increase from 70 to 85, your dwelling units actually come down by 18%. If it jumps to 100 square meter, your number of dwelling units will decrease by 30%. What it means that previously, let's say on a parcel of land, where it was subject to say 70 square meter and you can build 100 units there, when we are now subject to another rule where say the dwelling units has been reduced by 30%. So instead of 100 units, this same parcel of land, you can now only build 70 units. So you have 30 units less. So you need to find another parcel of land to actually make up for so-called this kind of shortfall so that the supply goes back to equilibrium. And when you have larger unit size, in a way, if prices doesn't change, it can only mean higher quantum for you, which we show here in this chart, that the quantum we estimate if, let's say, from this size, from 70 jump up to 100 square meter, and the selling price stays the same at $2,000 per square foot, you are going to see an increase in the quantum of more than $600,000. It's a very, very huge sum of money. And then if we go back to the District 15 map, and we just look at the supply numbers there, there are actually not a lot of supply that you can actually choose from itself. We are looking at these numbers here, and when we add all these numbers, it's actually make up only about 5%, or rather, I would say everything about 1,000 units right now that we are looking at in District 15 out of the entire island, about 21,000 units that is unsold. So it is very, very limited. And when this 100 square meter ruling actually affect more and more developments coming up, you can expect that the supply of new homes here to get lesser and lesser. The only new homes that you're going to get is probably at Embassy and then Live at MB. These are the two new that will be upcoming. Embassy likely to be in this year, Live at MB probably late this year or maybe next year itself. So when supply is not able to meet up with demand, because so many people wants to live here, you can imagine what will the price be for District 15 homes in the future. They will definitely be supported at this price point, and when demand increases more, and then you can't actually match that demand, prices is likely to actually increase as well. So what can we expect when we move forward? So of course, the very first question is that back to this is, I want to increase the supply, and we think that government should increase the supply. Otherwise, really, the price increase is not by virtue of, say, anybody trying to push up prices in the market, but because we do not have enough supply trying to catch up with demand. Now, if we look at en bloc market, right now what we have here is that these 4 residential sites have been sold this year, as well as one last year, if I can remember. And then when you add up the GFA that you have here itself, it comes out to probably 100 odd units. That means the first 4 sites. If I assume all the rest of the en bloc or private residential sites from here, from this Bukit Timah Road all the way until Vicenta Lodge are sold, that means every en bloc sites that you launch in the market are all fully sold. And I add up all the GFA here, and I do an estimate, it probably comes to around 1,000 units. It is a small drop in the ocean compared to what we had in terms of demand, where we sell more than 9,000 units in a year. It is definitely not enough. Then the other, of course, is the government side, the GLS, government land sales. What we have right now is all those are on the confirmed list since last year as well as this year. And the first parcel of land, North Umber land, has closed. But when we add all this here up, it comes out to 2,700 units itself. Much better than what we had in the en bloc side, but then still very, very low. And then, of course, the site at North Umber land attracted prices that is actually more than 10% higher than the previous site sold in the area. But then again, when we look at all these, developers are very, very cautious in bidding for that. Actually, that actually means good news for buyers in a sense, because developers are not going in to actually pay substantially higher. So in a way, that also means that prices are not likely to move up a lot, and actually helps make sure that market is also sustainable as well. And other lands will be like Company Street 62, which is for EC. These are the few that are coming up also. Of course, on the government land sales side, you have also parcels of land on the reserve list, which I add in right now at the last 4 parcels of land. And add all this up, estimate is probably about 5,000 units. Every site on the reserve list triggered and sold. This is going to be added to the so-called market itself. we feel that it is still grossly undersupplied. Why? In 2019, the market so-called sold more than 9,900 units. 2020, again, we did even better. We sold even more than 2019 and close to 10,000 units. And we will just look at first quarter itself, we sold close to 3,500 units. If this kind of pace continue, or let's say I take it that this year we only sell between 9,000 and 10,000 units, you are going to deplete what you have in just now we're 21,600. Let's say remaining of the year, you sell another 6,000 units, for example. You bring down to 15,000, which is going to touch the record low, which I highlighted earlier. And then can we add enough supply? The answer is actually no. What we have earlier, the 5,000 odd and 1,000 plus some of the sites which actually sold late 2020, which I didn't refer, it probably adds up to slightly around 7,000 units. So we are going to sell more than 9,000 units in a year. Yet we are going to add 7,000 units into the market. And these 7,000 units is not going to be added into 2021. They are going to come out in 2022. For example, the 1C Evening Road, developer has said that they just bought the land. They are going to launch it next year. So you can imagine even the government land sales with all the tender closing in April, June, and then the second half of the government land sales coming up, they are going to be added to the market only in 2022 and some will be in 2023. This year, we are going to live in a period where there is actually short supply in the market, and that is going to support the prices moving upwards. That's why I say that we are grossly undersupplied in the market, and this is something that is really, really hard to reverse in 2021. It is likely going to be reversed a bit better in 2022. Therefore, prices are likely to trend higher, and even prices trend higher is not by virtue of, say, because land prices has moved up a lot or whatever, but there are other cost pressure in the market coming predominantly from the construction sector. We have bans on foreign workers coming in from India that is going to increase the construction costs in this year and probably into 2022. And because of COVID, I think this kind of cost pressure is going to come in and affect quite a number of sectors, as particularly the construction side, because we rely quite a fair bit on foreign workers in this industry itself. If there's travel ban and this particular country is the main source of our foreign worker, that's where the cost will move upwards. Even material cost wise will move upward as well. So all these are going to creep upwards into the price index in 2021. And then this article, it was on the digital part of Business Time yesterday. Somehow the whole article disappeared. I don't know for whatever reason. But one thing to note, if you can Google for this exact title here, but take note of this area that is in red. We are also concerned about this also, which we highlighted when the HDB numbers came out on the 23rd of April. It's on our website under Huttons Group /news. You can read about that, our comments on HDB market. The HDB market since the circuit breaker till now has increased by 7.8%, whereas private market increased by 6.2%. So which of the market is starting to get unaffordable for the buyers? Based on these numbers, actually the HDB market, should the government be more concerned about HDB rather than the private market? Is that question, but probably they can answer itself. But we think that the HDB is probably more in need of attention, and the private market just ensure that you have sufficient land supply, you'll be able to so-called address the supply-demand imbalance itself. And even if government should come up with cooling measure, should you be afraid of the cooling measure itself? Actually, here we had, I'm going to show you this chart here also. We had cooling measure on the 6th of July, which took effect on 6th of July 2018. Since then, the third quarter until now, first quarter of 2021, the property market has continued to move upwards. Prices has increased by close to 9%. So has that cooling measure, in a way, start to impact and start to slow down the whole price increase in the property market? I think this chart here will probably give you an answer, no. And on top of that, we have the economy recovering, world economy recovering, and MAS just said yesterday that we are likely to exceed the upper range of 6% for Singapore economy growth in 2021. That is very, very good news for everybody in Singapore. And the total employment has turned the corner. In the first quarter, we have gone back to positive employment numbers. We added close to 5,000 jobs in 2021 in the first quarter. Not only that, residents, like what I said, that ample liquidity, they are spending almost the same amount in 2020 compared to 2019. Of course, you can see here is that the grey one disappeared, but that is because we cannot travel. So most of that disappeared and then came back to the local spending over here in Singapore. That's how they have supported part of the retail market in 2021 as well. And of course, some of this money actually flowed over to equities market and then into the property market. So the outlook here, I'm going to summarize this into simple 3 points. Supply. Remember, the unsold uncompleted units is coming down very, very fast, dangerously low, 21,602 units now as of first quarter. Government land sale supply is still below the normal level. Even if you increase more supply in the second half of the GLS program, the supply will only come into the market in 2022. It will not address anything in 2021. And en bloc supply is returning slowly again. Anything that comes out there will only come to the market in 2022. And we add the GLS en bloc supply, probably it gives you about 7,000 units. Not enough to quench the thirst of more than 9,000 units that we've sold average for the past 5 years. Demand side, we have stronger economic growth. MAS say that we are going to grow stronger than 6% in 2021. It is actually more than what they have forecasted. And the employment numbers actually back to growth, created close to 5,000 in the first quarter. And we are going to see positive numbers likely moving forward as well. And of course, buyers shifting their money around, seeking stable assets here and there. Some will go to the equities market, some will go to the property market as well. So on balance, we are going to see price growth up to 5% in 2021. In fact, 5%, I think we are being conservative over here. Just the construction cost pressure there, I think that is going to add perhaps 1 or 2% to the price itself. Then of course, with quite a fair bit of projects in 2021 in the high-end market, you are going to see price moving upwards in this year. So that's all I have today. Thank you for joining us. Enjoy your lunch. Bye-bye.